All right, Patrick, the next topic we want to tackle is why we don't expect the bubble to burst. And, people love to refer to the real estate market as a bubble all the time. I mean, I think over the last 15 years I've been or just under 15 years I've been investing in real estate. I've constantly heard this word bubble. I've never seen any bubble pop yet, Patrick. And who knows? Maybe now, the question is now the time the bubble's going to pop? Because that's what some people are expecting. So we got some fantastic graphs we want to show and some really great visuals to talk about this bubble and whether or not it's going to burst.
It's interesting. In my YouTube feed, I have a couple of guys that show up that are really well followed, and I force myself to listen to them. And it is just absolutely unbelievable, the negativity and how housing is going to crash and nobody can see it, but they can see it. And don't they know that these prices and affordability, and they're really have no argument for why they think this whole market's going to crash. Of course, they don't talk about when that time frame might be or what they're calling a crash and what might it be. I mean, it really is ridiculous in terms of the exuberance they put behind the Canadian market is going to crash. And it's like, settle down, you guys. Let's just look at what's really happening. So I can see the sense that, does this make sense? Do these economic conditions make any sense? It's like interest rates are high, listings are down, listings are up, sales are down. At some point, you think the real estate market has got to come off. And actually, I agree that it probably will come off, but it's not going to be this bubble that bursts. It may have some air deflated from it, especially when you look at the highs of 21 and 22. Those were the boom parts of the real estate cycle, JG. You and I've talked about it so many times. And will they come down? Yes. And this is where smart or savvy investors who are paying attention, who aren't buying into the hype, buying into the headlines, or just looking at the economic fundamentals, start to see that this is, in fact, opening some doors of opportunity. So in this particular case, we're talking about population growth. The government, now, I was about to say the government is committed to continuing with the immigration, and they have to, because of course our net growth from a natural way of having children is way down. Like it's like ridiculously low. So we need immigration. The government continues.
But I got to say, Patrick, you and I have a couple friends that we know very well. And they each have 5, 6, 7 kids each. I mean, I'm thinking they're doing their part for sure. I mean, I'm not doing my part, but they're doing their part for sure.
You're not doing your part, but they're making up for your slowness or your lack of. But my point is this: is that should we trust the government if they're at some point get a lot of pressure put on them? Will they back off of immigration? Yeah, perhaps. But let's just put it this way. Even if they cut immigration in half, JG, we were over 1 million people came into this country looking and having to find accommodations to live, whether that be international students, temporary workers, or even permanent residents. So even if they cut all of that in half, it's still a ridiculous amount. I don't want to say ridiculous. It's still a lot of people coming into the country that need a place to live. So that that alone is going to help put a bottom, a floor under real estate. And certainly in the rental demand component of it, and of course, as being a rental housing provider, what do we want to know? We want to know that we've got a lineup of clients that want to live in our properties. So it's all to say that when we look at why there isn't going to be a bubble, interest rates are an influencer. They're not going to be high forever. And I mean, we don't know, but let's say over the next couple of years, they're going to come down a little bit. Things are going to soften. Unemployment starting, we'll talk about that in a minute. Unemployment's starting to soften, but it's not coming off the rails. And when we look regionally, when we look at the regional numbers, some areas are going to be softer than others, but there's nothing that says this bubble's going to burst, like poof.
Now, let's talk about that, Pat. Let's unpack that because that I call one of those, by the way, I call that a Patrick pontification right there, which I love. I'm a big fan of them. But let's unpack it. First things first is you talked about people talk about a bubble, but people have to understand that their own benchmark plays a role in that bubble, right? And what I mean, and you talked about, if you could. The bubble is based on what benchmark? Where are you benchmarking to? Are you benchmarking to November of 2021 when stuff was completely artificially inflated because of all the cheap money that was flooding into the market? Is that the benchmark in your mind, or is the benchmark 2019, or is the benchmark 2015? What is the benchmark in your mind? Because that makes a big difference. And I think if you ask the average person that question that talks about a bubble patch, you say, listen, what's your benchmark for that assessment you're making? You'll always get a very, very interesting answer that will have an unrealistic benchmark. And that's the beginning of people who make these comments about bubbles, is they have an unrealistic and an unfounded benchmark that they can't. And of course, that benchmark doesn't make sense. Therefore, the rest of it doesn't make sense in my mind.
Oh, 100%. And I think what, the majority of people, the masses, will look at and say, well, this is what the headlines say. So they're just reading the headlines and buying into the headline. I want to just say something is, we've done a couple of live meetings, and when we look from an investment point of view, and I don't know if this is the best time to kind of shine a light on this, but those individuals who are showing up for our live events, for our virtual events, who are really educating themselves on what drives real estate, what is the economic fundamentals that lead real estate so that we can make great decisions. That is like when we talk about good to great, the difference between good or average and great is literally less than 10% of paying attention a little bit more. And so for investors who are watching the economic fundamentals, why we do these shows, is to provide some real substance of why real estate is doing what it's doing and why we think it's going where it's going, because it's based on data, not on emotional headlines. And we're not buying into there's going to be a bubble, because it makes absolutely no sense. Now, having said that, maybe that's just a term. Is it going to be softening in some regions? Yes. Is it a bubble? I just can't make it make sense.
Now, let's talk this bond yield, Patrick, for a second, because this is one of the reasons we believe that we're not going to see a bubble burst, is because bond yields are finally going in the right direction from our perspective, which is they're coming down. And just so everybody knows, bond yields is how fixed rate mortgages are priced. So when the Bank of Canada raises interest rates, that doesn't impact fixed rate mortgages. That impacts variable rate mortgages, but not fixed rate mortgages. But the 5-year government bond, that's how we price fixed rate mortgages. And that, Patrick, went up to almost 4.5% in the last month or so, and we're already down to 3.87%, which is, and by the way, we went to a low of 3.77%. So that's fantastic. We're seeing some pretty massive swings in this 5-year government bond. The point is where's it going to settle and where's it going to level it out? But this is how fixed rate mortgages are priced. And when this is going down, you can expect fixed rate mortgages to be going down into the future.
Yeah, they will eventually follow. But I think when you look at this is just a 6-month chart. But if you look at it over the course of a year, these yields have been the most erratic in history, which speaks to the uncertainty of the market. So when we do future thinking, we start to see these bond yields come down a little bit. It's actually the market saying where they think things are going to go. So that may mean a softening economy. It could mean a lot of different things. But the point is that they are coming down. I think you might get it spike up and then it'll come back down again. That just speaks to the uncertainty of the market. But this, for us as investors, is good news on the fixed rate side.
I called this real estate market, Patrick, a couple months ago. I think it was in August. I called it a slingshot market that was kind of starting to really, people were going to sit on their hands and this was going to build up momentum. And eventually we're going to let go of this slingshot. And I think one of the things that's going to help is the interest rates. When the interest rates come down enough, both, by the way, the Bank of Canada rate will help because that impacts things like credit cards, it impacts things like lines of credit, it impacts things like car loans. It really impacts the day-to-day living, as well as variable rate mortgages, which a lot of people are on. But if they both start coming down, the 5-year government bond yield and the Bank of Canada rate, whether it just stays fixed for a while, which it now has, and it starts to come down, I think you're going to see a lot of pent-up energy in the real estate market start to get unleashed. And then I'll be able to say I was right on the slingshot, Patrick. We'll see.
We'll see. I want to share a quick story here. Is that a friend of mine, I kind of reached out, or he reached out to me yesterday, and we talk about the pressure of interest rates and the variable rate versus fixed rates, and some of the investors that are getting in trouble. In the past 90 days in Alberta, I won't say where, but in Alberta, he's done almost 15 agreements for sale with people who are in trouble. Now, he's got fairly deep pockets, so he's taking it on and he's readjusting because he sees the I guess where they're not maximizing rents, for example. So he sees opportunity to, in fact, bring those properties back to cash flow. That's part one. Part two is he's got a lot of doors, and he feels like a little bit of a genius because he locked in really low rates in 2020. But guess what? That means in 2025, those 1.5 rates that he locked in are now going to go and be renewed. So I was giving him a hard time going, okay, well, I hope you're planning for that increase, because otherwise there's going to be AFS coming your direction. You're going to be hoping that you can get out on an AFS. So anyways, a little bit of a funny story, but these are things that are happening in the market.
Here's another great chart, folks. You got to remember this. This is so important. We say it every episode, but you got to remember, people love to talk about a Canadian real estate market. There's no such thing as a Canadian real estate market. So right now we're talking about a balanced market across the country. Meanwhile, there's many parts of Ontario that are in a serious buyer's market, and there's many parts of Alberta that are in a strong seller's market. So, don't buy into the headlines of a balanced market or anything regarding a Canadian market. Really do your research on your particular region. And that goes beyond, Patrick. Often we break down provinces. We talk about Alberta, we talk about Ontario, we talk about BC, and that's great because it's better than the Canadian market, but it's not good enough. The sophisticated investors have got to go right down to their actual region, meaning the municipality you're investing in.
Well, it's interesting. We just, let's shine a light on it for a quick minute. We did a live meeting here in British Columbia last night in Langley. And what was interesting about that is one of our trusted partners, who is Fraser Valley, Lower Mainland, Vancouver, BC, actually, he went through a bunch of stats. I think he probably had at least a dozen regions, Chilliwack and Mission and, Abbotsford, and of course into the Lower Mainland and Surrey. And he looked at all those regions, and guess what? Those are all within an hour and a half drive of each other. And the markets, buyer's market, seller's market, buyers, neutral, that's how regional it is. And it also speaks to why we need to pay attention to those specific regions when we look at what's happening economically.
Here's another great chart on house price expectations, which is Bank of Canada did this. I shouldn't have said that because Patrick's going to discount it immediately. If it says the words Bank of Canada on it, it's out of Patrick's mind. But anyways, let me continue, which is this survey shows at the beginning of the year, the average person from this survey was expecting their house to appreciate about 2% at the beginning of the year. So pessimism was at its highest. People were only expecting real estate to go up 2%. Now the expectation is that prices will rise 5%. So the expectation from house prices are starting to reverse again. And Patrick, it's funny because I will continue to say this for several months. So hopefully you guys hear me, folks. It was exactly 2 years ago we stood on this on this very channel, doing YouTube, doing live streams, and Patrick, you and I were saying, folks, you've got to be careful. We're at the height of the market, and those who listened and who backed off were very, very happy. And I've been saying for some time, folks, there's still some pain ahead, yes, but we're definitely on the backside of this slide. You're at the bottom. Are you at the tip top? Or sorry, are you at the really bottom of the bottom? I don't know. I'm not a fortune teller. I can't tell that, but I can tell you that we're way closer to being out of this problem than we are to get into this problem from my perspective, Patrick. So, and this is just, you're starting to see things turn from my perspective. Still some pain ahead, but some interesting things coming up as well.
Well, I don't know. When we look at house price expectations, again, the Bank of Canada did the survey. We don't know who's in that survey. They could have taken a poll with a bunch of realtors, and what are realtors going to say? Things are going up. You should buy now. I'm going to leave it at that.
Yeah, well, they're not wrong. Okay, Patrick, another chart that I wanted to cover. We talked a little bit about this. These are leading indicators, but consumer sentiment still not great. Definitely at lows of lows.
Listen, I'm going to say it again and just keep hitting it, is that we have to understand that as a country, we are debt-driven consumerism, and that includes housing. And so what's happening right now is when consumers lack confidence or lack the cash flow to go out and buy because they're paying ridiculous amounts of tax. I don't even want to, I think there's like 20 or 15 new taxes. Like, don't even get me started on that. The point is this, is that consumers are less confident because they have less disposable income, so they're not spending as much. That, in fact, slows down an economy. And so it is a bit of a leading indicator for sure, and businesses are feeling the same way. They can't afford it because of interest rates, so if they're not feeling confident about business going forward because consumers aren't spending, they're not building up inventory. They're not actually improving on what their productivity might be. They're not investing in equipment to produce more. They're actually tapping on the brake, which slows the economy down. All to say this, is consumer confidence is such a big indicator of what we see. Now, does that mean things are going to crash and that we're going into a hard recession? No, none of that. What it means is things are going to slow down and people are going to slow things down, which is what we're seeing. And, because we're not particularly productive as a country, which is a whole different conversation, but manufacturing continues to trend down. We're not producing goods. We're not exporting. I mean, we're bragging about 1 month of a $2 billion more export than import. I mean, who cares? Let's do that on a regular basis, and then we can start to talk. And we're not actually shipping and producing and or selling commodities the way we have the ability to, and the commodities that we have, resources that we have. So it's all to say this, is we have to pay attention to the fact that as housing does slow down, that crash, but slow down, is that affects a lot of jobs. So we're going to start to see more and more people be nervous about their jobs. And in fact, there may be some layoffs that we're starting to see in that construction industry. That'll start to slow things down as well.
Let's get to employment, Patrick. Let's talk about this chart here. Speaking about employment growth.
Well, there you go. So you can start to see, in fact, the slowdown that is happening. It's not to say that it's going to come off the rails. Again, we're going to see different provinces, different cities with different levels of employment and unemployment. But ultimately, we're still in good shape. If you start to listen to some of the news out there, there's lots of talk about the construction industry and the fact that builders have touched the brake. The thing about all of this is businesses do, in fact, slow down, touch the brake. There's some conversation, and I was watching some numbers the other day, which is like business insolvencies are up 42%. But the lack of detail of that statement. Well, okay, so business insolvencies. What business are they? Solopreneurs, entrepreneurs? Like literally, are they one-man shows? Are they three-man shows? Are they 300 employee businesses? No. So these are things that we got to look when we look behind the headlines. The point is this: employment growth, although it's softening, still is pretty strong, as is unemployment. If it comes up a little bit, I've said before, if we get into the 6.5% range, it's still a very healthy number.
And one of the things we got to keep in mind, and don't have enough time for it on this show, but definitely, as you can see, what I like about this chart is it goes all the way back to 2007. So you actually see the last dip there in 2008, 2009 when we get through the great financial crisis. But as we came out of that great financial crisis, you can see how employment growth really slowed down. What's going to be different this time around, Patrick, is technology is very, very, very different in 2024 than it was in 2010. That's 14 years of technological advancement. I'm very curious to see how employment is going to react as technology rolls out. And we got some pretty huge tech that's hitting the streets right now with artificial intelligence and so on and so forth. So we're definitely going to keep our eye close to this because I think it will be fascinating.
Well, I think there's something to be said here, JG, just as an example. So I'm not an expert in the oil and gas industry, but I do certainly have some background and I do pay attention to what's going on. So when we look at oil and gas, it's always about Alberta and all the rest of it. I get all that. But listen, oil and gas is important to Canada as a country. And what we're starting to see is that the development in the oil and gas industry, the game changed over the past 10 years. You used to have a lot of what was referred to, and still is, roughnecks working the rig. Well, you needed a lot of people to do that. Well, technology has changed the game. You need less people. What's happening in Fort McMurray, for example, in what they do in the oil and gas industry is driven by technology. And so we need less labor, traditional, and everybody could get really freaked out about that, saying, well, we're going to lose jobs for trades, or we're going to lose jobs for that labor force, the actual physical labor force. But what we're picking up on is the need for engineers. And I'm not talking about I'm talking about engineers in terms of technology and technology development. So it's just a shift of the jobs that are going to be required. Will it require less people overall? Perhaps that's yet to be seen, because to drive that level of technology, you just need a different workforce, a different education, and a different competency. That's my kind of read on it right now. And I don't know what your thoughts are on that.
Well, I totally agree, Patrick. And this as the, and again, back to real estate, I want to bring it back to being a real estate investor, because I think these are great points you're making, Patrick. And there's going to be a ton of opinions, by the way, about this. Again, to Canada as a country and to different provinces. But as an investor, you're investing in a city. You're actually investing in the neighborhood, and you have to be careful of what happens in those neighborhood profiles. So I'll give you a perfect example, Patrick, of what you're talking about. If you're an investor in Fort McMurray, you've seen this firsthand in the last 10 years. What happened if you invest in Fort McMurray specifically? It's gone through a massive transition, a huge changeover as technology rolled through that industry. But if you're investing in Ottawa, Ontario, what's happened in the oil fields has had no impact on your investment whatsoever. Zero, nada. That's important, Patrick, because where someone invests is critical. And as these industries start going through these technological rollovers, improvements, enhancements, upgrades, whatever you want to call it, it will impact people differently. And real estate investors have to be really, really well connected to what's going to happen in their neighborhood.
I got a comment.
You're just speechless. That was so deep and profound. You're speechless.
Well, I don't know. You know, JG, you've made some really great points there. I don't really have anything to add to that. I think you're pretty thorough.
Awesome. Anyways, that's enough. And that covers us as to why we don't expect the real estate bubble to burst. Let's move on.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.